bike rack fell off and caused a massive crash of bicycles on his garage floor.
Yeah.
And the following week he fell off and basically broke his nose.
Yeah.
Massive black eye.
Okay.
It's supposed to be a healthy sport, but apparently not where I'm concerned. There we are.
Right. Hello, everyone, and welcome to Taking Stock After the Bell, episode 55. Delighted to be joined by Alex Wright, the manager of Fidelity Special Values Investment Trust and the Fidelity Special Situations Funds. Alex has been with Fidelity since 2001, beginning his career as a pan-European analyst, rotating across a number of different equity sectors. In 2007, he chose to focus on UK equities, initially as a small cap analyst, where he worked closely with Anthony Bolton and Sanjeev Shah, the two previous managers of the Special Values Investment Trust. In September 2012, Alex took over the Fidelity Special Values Trust from Sanjeev Shah, and in 2014 took over the running of the Fidelity Special Situations Fund. So a more than a 10-year track record. Alex graduated from Warwick University with a first-class honours degree in economics and is a CFA charter holder. Alex, welcome to Quarter to our fine new podcast studio where we are running it out for the first time today.
Thanks very much for having me. Great to be here.
Good. So we've got a few slides and a few things to talk about. As we were sort of discussing there in the intro, I mean, it's not really been a terrible time for UK equities, is it? I mean, it's very different to what you sort of read in the papers. I guess I sort of start off with a slightly more sort of taking a step back. I mean, you started your career in the early noughties at the sort of as the dot-com bubble was blowing up, I guess. Husey and I talk about this a bit because we started our careers slightly later than you, not around the same sort of time. Do you think that those early years starting out and what was going on in markets has impacted your sort of overall philosophy, or do you feel as though you have a philosophy, and how has that been shaped by your sort of career progression, if you like?
Yeah, I think not really, because obviously I wasn't here for sort of the run up in the dot-com boom, and then sort of, as I started, you don't necessarily, you see what's sort of going on. Like, it was a very lively time. I actually started in the office September the 10th, 2001.
Oh, wow, the day after.
The
day after 9/11. Wow.
The day before.
The day before, sorry,
yeah. So it was clearly a volatile time in markets, but I think when you're first into the city, you don't really know what's going on. You see what's happening in markets. So after you've been around for sort of 4 or 5 years and really have an idea of what's going on, that sort of shapes sort of much more about what's going on. Yeah. So obviously we started managing money just before the GFC, and that was a much bigger bigger experience. Yeah, I remember sort of the small cap fund started by the end of the first year. We only started March 1st. We were down 35% and we'd beaten the index by 20%.
Wow. No way.
So we had a sort of what you call a relatively good performance, but obviously a terrible absolute performance. Yeah. So I think, a reminder of sort of that volatility can be very high, and that things can change very substantially. Yeah. It's definitely something that's sort of etched into my fund management career more so than sort of really being able to sort of call, the tech bubble looked like this. That happened a little bit before we got into the city and was very much unwinding by the time we were there.
Because I always sort of say to Hughes, so when we started 05, 06, no one really talked about tech. It was just sort of a sector that just wasn't discussed. The only thing we wanted to discuss was Royal Bank of Scotland, BHP Billiton and Rio Tinto, which were the only, and BRICS funds, which were the only things you ever wanted to buy, right?
Mm-hmm. Every portfolio had Tesco's in for some yield.
Yeah, £4 a share.
Yeah.
Good. No, and I think one of the more interesting things that Husey and I sit down with clients, advisors pretty regularly, and the one thing that's sort of clear at the moment is, all clients think the world's going to hell, and they all look at the news, both in the UK and internationally, and they look at the portfolio and they go, "Oh, it's done all right. Well, why is our portfolios doing so well despite the world?" I mean, what's your sort of view on the general malaise, both in the UK economy and sort of slightly wider in terms of the geopolitics as well?
Oof. Yeah, big question.
That's easy question.
So I think so clearly geopolitics and its effect on economics is far larger than I guess investors have been used to over kind of the last 20 years. Because the last 20 years there weren't any meaningful wars. There was a reasonably sort of well understood sort of rules-based international system. There was a degree of predictability around sort of global economic policy, and also the US's place as kind of the world's sort of economic and political policeman. So clearly, lots of things have changed, and also through that as well, there was the sort of globalization, free trade, entry of China, huge disinflationary push from that massive urbanization of that population. And clearly all those previous trends are sort of gone into reverse, which I think, unfortunately, when you think very long term, when you're sort of talking on a sort of 10, 15-year view, that's probably going to mean a much lower growth, higher inflation, less good for financial assets outlook, because deflation, lower interest rates generally led to higher asset prices and a really good economic environment. So I think that, unfortunately, is probably long-term picture, that the incredibly good returns, 10% plus type returns that you've been able to see from sort of portfolios, is something people should not expect on average over the medium term going forward, because all of those factors are negative. Like tariffs are negative for economic growth. Unpredictability is bad for economic growth. The sort of balkanization and separation of the world is bad for economic growth. So it is a little bit of a surprise that in the short term asset markets have continued to be so strong, because all of those long-term factors are negative compared to history.
And do you think part of that's just that a lot of people running money have just been taught to buy the dip, and every time and sort of ignore a lot of what's going on in a way? They're just chasing themes.
Oh, most definitely. And I think also you can see that in things like retail participation, particularly in the US, the retail investor that has become a much more powerful force. Again, something that generally happens towards the end of booms or bubbles. So again, that's another negative sign, I would say.
On the flip side, though, companies in the aggregate appear to be doing okay. And I'm somewhat surprised at how kind of resilient they've been. I mean, do you sort of buy this view that company management and companies in general are a lot more agile and able to kind of dodge the metaphorical bullets, pardon the pun?
Well, I think obviously you've been through a lot of really hard tests over the last sort of 10 years, particularly if you're a UK company. It would have started with sort of Brexit, and then you would have obviously had COVID, the mini budget. So there's been an awful lot of things that you've had to get used to. So again, I think companies have become increasingly good at contingency planning and dealing with big shocks that you wouldn't have expected would have been possible historically. So I think there is something that you've sort of been battle hardened, and again, I particularly like investing in those areas where sort of companies have had tough times and you can see how they've reacted to them, and trying to avoid areas sort of that haven't had tough times, because that when a tough time turns up, you're more likely to slip up if you haven't sort of been used to it. So I think that's a particular resilience of UK companies, because we've had more than the average number of shocks, but globally we've had a decent number of shocks. I think it's fair.
And then do you think companies, if they're sort of battle hardened and a little bit siege mentality, do you think they could be put in a position to be more optimistic and positive? And if we look at the UK economy, it's clearly not firing on all cylinders. I mean, fundamentally, it seems fine, as I keep saying to everybody. Consumer balance sheets are very strong. Unemployment is relatively low. It's going up a little bit, and wage growth is decent. So, fundamentally, I sort of think that UK consumers and households are in good shape, but that's not translating into confidence and optimism and spending.
I think it's interesting. So I think firms have got used to live with the shocks, but I think actually consumers have not really, in terms of it's really consumers that have held back in the UK and also in Europe, to be honest. So I think to a degree the inflation shocks have been bigger here because of the cost of energy in the UK and Europe. and then the volatility of politics, the closer proximity of the Ukraine war to Europe than you've seen in the US, has meant that consumers have really held back.
Yeah.
Now, for me, that is a good basis to invest, because you've got those strong balance sheet, high savings rates, lower credit card debt. That means if things just don't get worse, then there is money to sort of spend, and things could just not get worse, and actually the picture then could be good. I think that's quite different from the US consumer, which has really been shielded from some of those shocks. And you can see sort of debt levels are very high in the US. Consumer spending is very high. Credit card debt is high, and defaults are rising.
Bottom end of the
So
income.
that is something that very much concerns
savings
me.
rates have come down.
Yeah,
a
savings
lot,
rates have fallen a lot post-COVID.
Because that's one of the things with the UK is, how do we get UK consumers spending? Because at the moment they're just hoarding still, aren't they?
Yeah, that's definitely the case. That consumers have the money to spend, and indeed, particularly at low end, because minimum wage has been growing strongly, that the disposable income has been rising, but consumers haven't been spending that. So I think it very much is a confidence thing.
We'd also sort of take a step back. You've been managing the Fidelity Special Values Trust since 2012, and we'll just flash this slide up now. We haven't quite yet got the TV working in here, but maybe next time. Since presumably this is the start of your tenure, in 2012, the net asset value of the trust is up 325% to the end of August, compared to the FTSE All Share up 167%. So some pretty decent outperformance there. If we and we sort of touched on it in the sort of intro a little bit, but if we zoom in a little bit more on the sort of what's happening here and now, I mean, actually, UK equities haven't been a terrible place to be. Year to date, we've got the UK market and emerging markets up about 15% total return, compared to a UK investor in the S&P 500 and the US equity index, where the US market is only up about 5 or 6%, mainly as a result of a kind of currency drag.
Yep.
Is there any sort of optimism? And you talk to a lot of investors and also a lot of companies, but is there a sort of feeling that maybe global investors are beginning to look at the UK a bit more, and is that sort of something that we see will come through?
Well, definitely. Ultimately, markets are a demand and supply. So for the markets to go up and outperform, that means demand is higher than supply. So if we look at sort of flows into open-ended funds from UK investors,
we've got that chart here.
Yeah,
actually.
those are still
Slide 5
negative. So while Special Sits is actually seeing some inflows for the first time in almost 20 years, which is great to see.
Yeah.
That is very rare, actually. There's only a handful of funds, I would say, of the 240 available in the UK that are actually getting inflows. Most UK investors are still divesting from the UK. So that means that someone is clearly coming in to fill that gap. And I think it is increasingly, global and US investors are looking to allocate some of the money they have from the US outside of the US. Actually, we just saw someone from our sister company yesterday, and they were the portfolios there are all positioned overweight ex-US, because the valuation gap in the US is just very, very high compared to international markets. And also, clearly, I think, while it's sort of the actions of the new Trump administration has somewhat spooked people outside of the US, they particularly spooked investors in the US. The sort of the unpredictability, the sort of worries around Fed independence, institutional dependence, how reliable data is when you've got 75% plus of your assets invested in that one market. That makes you think. So you don't need to move very much of your assets to international markets just because of the pure quantum. You just sort of look. The whole UK market, I think, is smaller than sort of some of the Mag 7 market caps. So it's a tiny amount of money needs to move to make quite a big difference. And if you think, clearly, if you're a US investor, where is it most easy to sort of move some of your allocation? Clearly, the UK, with strong corporate governance, same language, good access to management, it's a much easier move than it is to other markets where it might be more difficult to invest, particularly in more mid and small cap companies. Sort of it's harder to see managements from smaller European companies, Japanese companies emerging markets, etc.
Yeah.
And out of interest, do they? I think in the UK we get quite negative about what's going on. I guess from a political point of view, do US investors not have those concerns? Sometimes I think we overly worry about the state of the country when actually it's all right. It's sort of still going along, as you say. It's got good corporate governance. We've got the best legal system in the world. Do they sort of want more international exposure, or are they happier with domestic focus?
So clearly the UK market is 74% of the UK market isn't actually playing the UK economy. Yeah. So the first thing is this: you can get international exposure in the UK market, and actually potentially quite similar geographic exposure to some of those US companies, but at a much lower valuation. So again, that's a particularly easy trade. But then I think there is certainly in some of the larger companies that there are US investors investing in things like the UK banks, which clearly are a play on the UK market, because the UK does have that very strong institutional system. They're obviously much maligned, but a very sort of strong and rules-based sort of civil service and court system, which I think is a bedrock of sort of serious investors.
Totally.
I totally agree. I mean, and if we take a look at the UK market, in terms of how the UK market has performed versus international, yes, we had that pretty dreadful period, effectively 2015, 2016 through to 2020. We've got the chart here, chart 4, Alex. But actually, since 2020, the UK market has performed pretty much in line with the rest of the world. Yeah, okay, it's been a little bit kind of up and down on a relative basis, but that just sort of, speaks to this point. But despite that, the UK market still looks on a kind of very healthy valuation discount, doesn't it, to the rest of the world? Yep. So we've got a chart here, chart 6, of this is a sector neutral valuation. So this strips out the impact of kind of tech versus oil,
primarily. Yep.
Showing that the UK market remains on a kind of 15-20% discount to its, typical average over the last 20-25 years. I mean, surely there has to be, some sort of help in terms of the UK market and
yeah, definitely. And I suppose what's particularly pleasing to see is where the UK market sort of outperformed year to date, some of that valuation gap has actually started to close, because as you can sort of see, despite performance over the last 5 years being sort of somewhat in line, the valuation gap was actually further opening. So it was because earnings in the UK were sort of better, that the market was performing in line, not that the valuation gap was closing. Finally, you're starting to see a bit of that valuation gap close. I suppose the other thing that most people don't sort of reference when they sort of look at UK underperformance is just how expensive the UK market was back in 2015.
Yeah.
Because it wasn't. It's only 10 years ago, but actually the UK market and international markets have been sort of a go place to be, because the sectors that sort of drove the markets up to the GFC and a bit beyond in terms of sort of mining commodities, the UK market has an awful lot of those, and had a lot then, and was attracting new IPOs, sort of Glencore IPO. So again, international businesses were listing here. So it's amazing how quickly sort of people forget that actually sort of it wasn't that long ago that the UK was the place where people really wanted to be, and international investors very much flocking here.
Yeah, no, I hadn't thought that. The UK market was quite expensive. And of course, 2015, 2016 was the start of the big oil price sort of unwind, wasn't it? So that kind of undermined the earnings. And then also another good chart here in terms of valuation, a little bit simplistic perhaps, but the further down the market cap spectrum you go, the cheaper things get. So on your numbers, current P of the FTSE 250, the mid-cap index is about 12.5 times. And then the small cap index is even a bit less than that, in a sort of 11s, I think, when looking at the chart here.
Yep.
Is that sort of impacting or influencing where you're going in terms of new ideas?
Yeah, so it's interesting. We've used this chart, I think, for about a decade, and we've just had to sort of rename it because the UK market had been at a discount to its long-term average for pretty much that entire decade. And we've just seen the FTSE 100 just creep up to being marginally above its long-term average. But obviously that isn't reflected in the more mid and small cap part of the market.
Yeah.
And to be honest, that has always been a bigger hunting ground for the funds. So about 60% of the assets are invested in mid and small caps.
Do you think are investors in the market expecting high earnings to grow faster over the next few years than they have done historically? They probably are slightly, aren't they?
I think actually, well, there's a bit of nuance here because obviously there's in the very short term, because the pound's been so strong, that's quite a drag on earnings.
Yeah.
So earnings growth in the market this year is not
Sure.
particularly good. Actually, we forecast Fidelity on an aggregate basis earnings to be slightly negative in the UK market. First of all, because of that pound drag on 75% of the market, but also because oil prices are down year on year, and also commodity prices are down year on year. And then a few quite large stocks that have got down earnings. So when you're a big index weight like a sort of Diageo and your earnings are falling, that's a drag on the market. If we look more sort of medium term through 26 and 27, I think at Fidelity we're expecting earnings growth to be somewhat similar to the long-term average.
Okay.
So around sort of 5%. Okay. But obviously, given that you've got a decent yield coming out of the market as well, like if you just don't see any movement in valuations, you can easily get the sort of long-term return of the market, which is about sort of 7%. Just from sort of that level of earnings growth and dividend yield. So I think, earnings growth and valuation are all around sort of average for the UK market. So do I think the market has the ability to sort of compound at its long-term average about 7%? Yeah, I definitely do. Yeah. Now, that is very different from what I'd expect from the US market, because there you've seen much higher compounding of returns over the last decade. But a lot of that has come from a substantial re-rating of that market.
Yeah, sure.
And concentration of the earnings growth as well in those.
Yes, so it's become sort of riskier.
Yeah, absolutely. And just on that, there was a chart actually which piqued my interest that I, in terms of the takeover activity has been, and we're not going to put this up because it's very wordy, but we've got a sort of list here of stocks that are being taken private or have been bid for, et cetera, et cetera.
Yep.
Is that a theme that you think continues? And as we sort of chatted in the intro, that sort of, the number of stocks being taken out of the market is a lot greater than the number of stocks coming into the market. Is that is that negative overall for the UK market? And how do you sort of see?
Well, it's a clear positive for performance for the fund and for the market as a whole, because generally these stocks, I think year to date, it's about a 35% premium that we've seen on those takeovers. So generally, I would say that you're getting fair value for those stocks. It's just they're trading below fair value in the market. And I'd say that's been a clear trend that we've seen pretty much since 2021. Although interestingly, this year we've already received more takeover bids in aggregate than we did for the whole of last year, and we've still got a further 3 months to go. So that from what was already a reasonably high level, it's picked up to a higher level. I think what's strange is that in the past, you probably would have thought this level of activity would generally re-rate the market as a whole rather than just the specific stocks. But that hasn't happened, and I think that's why, therefore, the takeovers continue, because there is a big arbitrage between a US company buying a UK company or private companies buying a UK company, because private companies generally also benchmark off the world's largest market, which is the US. So what looks cheap to them is quite a long way ahead of where things are trading in the UK. And very much that has generally continued to also be the theme. And when you look at who the acquirers are, it tends to be private equity and US corporates. There are a few UK corporate deals as well, like the Backable Greencore deal and the Direct Line Aviva deal. But the majority would be private equity and US corporates.
Yeah, I mean, I always think with sort of valuations at the levels they are, if you're a US private equity house, it must be pretty easy to make the numbers add up in your spreadsheet to do a takeover at a 35% premium and give yourself a very nice IRR over the next 5, 7, 10 years or whatever it is. And then, are there any signs that the IPO market in the UK, for new companies, is there any signs that there is going to be any sort of renaissance or resurgence in the UK market anytime soon?
Well, so there are some signs. So that there's, I think, currently there is a small IPO on the blocks and a small one happened, but it's very much sort of at the margins. There has been more sign of things globally opening up. So there have been IPOs in Europe and the the US, and interestingly, a lot of IPOs in Hong Kong. So I think globally there is an increasing opening up of the IPO market. I guess as a contrarian, I don't generally actually take that as a particularly good sign, because if you think about it, in an IPO, it's sort of exactly the opposite of what I look for. It's sort of people trying to sort of paint a really good picture. It's an advantageous sign to sell because markets have gone up, valuations are higher. So we don't, as a rule, do IPOs. And indeed, lots of IPOs are generally a bad sign. Like, when did we last see a lot of IPOs in the UK? 2021, just around sort of the peak of the market before we saw a big sort of contraction in markets in 22.
And on your comment of sort of being a contrarian, I mean, one thing looking through, the slides and your positioning is you have the ability to be early and before sort of get invested before almost anyone else has thought of it or before valuations start moving. So there's your fund positioning chart. You had banks very early. Obviously, they've been fantastic performers over the last couple of years. I think looking here, you've started to add to resources, or that's crept up again. How do you? Because that is, I think it's most investors find it very difficult to buy sectors or stocks that are out of favour, because it's almost easier to ignore them because there's no commentary on it. There's you haven't quite seen the earnings start to move. But how sort of is that a team approach, or is it your approach, your training? Sorry, a few questions in there, but it's really interesting.
There's a lot of things to unpack in that. I think there is so clearly sort of there's a lot of training at Fidelity. We've got a really strong analyst team, and I've looked at lots of stocks before I became a fund manager. But actually, in terms of the type of fund manager you are, I think you have to have a certain personality about what excites you.
Yeah.
And Anthony was really good at sort of talking about this. You have to be sort of willing to sort of stand out on your own, like get excited about things that other people aren't excited about. And I suppose for me, it's valuations that really excite me. So actually something that doesn't have commentary, that is overlooked, that is complicated, that's out of favor, that is really exciting.
Yeah.
And actually I feel very uncomfortable in areas that are popular, where lots of other people are investing, where people are excited. That excitement for me spells sort of risk and danger. And so you are right, we tend to go to areas that are out of favor, but then the real training is sort of trying to work out sometimes things are out of favor because actually it's a really bad sector, and structurally things are really hard, and it's difficult to get out of problems. So that's where the sort of, I guess, the training really comes in, identifying sort of where something might be out of favor today, but in future may be in favor. And actually defense is a great one. Like we've invested.
I was going to pick up on that actually, because I've seen you've got the various stages of your investment cycle, haven't you? You've got Rolls-Royce in stage 3, which
and Babcock there as well. And those, so defense, I've owned pretty much every single UK defense company with the exception of BAE. And we started investing in that area probably in 2013, 2014, when actually defense was fundamentals were reasonably poor, because there was a pullback from sort of the big spend that happened through sort of Afghanistan and Iraq. And then the sector became very out of favor for sort of ESG reasons and sort of divestment from European investors. And that created just a lot of, I thought we've got a lot of good companies there that are producing sort of good revenues, good margins, and there is a need for these businesses, and there are long cycles. And so we've done particularly well. Many initially takeouts, so like Megit, Ultra were big positions, Chemring previously, and then big turnarounds like a Babcock, and then more into sort of things that were a bit hidden defense. So again, Serco's another big position. People didn't even really realize that was their biggest sector, I think, until recently. So I think as trends get more mature, you have to sort of move away from some of the more obvious plays, because you're really paying an awful lot of money for those.
Sure.
And so very much, we do have a position in Rolls-Royce, but we've been trimming that. We've trimmed that a lot, to be honest. That stock has probably done a lot better than than we expected and other investors expected. Similarly, actually, Babcock, we've made several 100% in that name. So not only has the turnaround come through at Babcock, but the environment has obviously dramatically improved for defence as well.
And the sort of the bank story is taking hold now, isn't it? There's a lot more enthusiasm for the financial sector in general. Is it still a big part of the portfolio? Or
I think it's different. So while banks have also done well, and again, there's many banks where we've made several 100%, but that's the earnings of banks have gone up a lot. And so unlike a Babcock or a Rolls-Royce, which are trading well over 20 times earnings now and are starting to sort of pop up in many investors' portfolios, the banks are still trading on sort of 7 or 8 times earnings if you look at a couple of years. So that's actually a similar valuation that we were looking at a couple of years out when we first bought them. So yes, they've done well, but on the back of earnings doing well, mainly because the interest rates have increased so much, but also the banks have intelligently used their capital and bought back a lot of stock, and that's been incredibly accretive. If you're buying back stock at 5-6 times earnings, which was kind of the valuations when they started doing it, it's incredibly attractive. And so that sector is still a very large part of the portfolio because the valuation is still very low, so about half the UK market multiple. So now banks are cyclical and are geared. So again, I don't think they should trade all the way up to the market average multiple, but the level of discount they're still at, I think, is still large.
Well, I think people assumed that interest rates, spiking post the Liz Truss budget, would rates would drift back down to the sort of 2s and the 3s, but base rates today are 4%, and actually come back to the kind of mega theme of higher inflation, more volatile environment. Interest rates are probably not going back to 0.5% anytime soon, and there's sort of the new normal is the old normal of 4%. Well, if you're a NatWest or a Barclays in the UK and you've got 4% as your sort of normal, that you've got some pretty attractive.
Yeah, well, to be honest, so again, these big macro picture things I think are difficult to call the exact level of interest rates, but actually the earnings of all the UK banks, as long as rates are above about 2%, are going to make very high returns on capital. So they're making sort of 17-18% returns on capital now. So that is a higher return than the UK market average. So these are higher quality stocks than the UK average, which again I think most people wouldn't think is the case, but certainly is the case in terms of returns. It's only at very low levels of interest rates that these stocks have an issue. So clear, if you think about the business model, the UK free current account banking, the way that is funded is through a return on interest, and you can't charge people to have a current account, and therefore sort of low levels of interest rate really challenge that model. So I don't worry too much about whether long-term interest rates are going to be 2, 3, 4, 5, 6. Anything in that range, I think the banks will generate very good returns. Clearly, if rates are above that will probably mean asset quality problems because it will be unaffordable for people who have made loans, and rates below that level make it very difficult to make money on the current account side. But that wide range of outcomes is something that I like to sort of see in terms of it's incredibly difficult to predict the point future. But within a very wide range, you can get good returns. That excites me. And also the fact the UK has quoted in the UK a very wide range of banks as well. So it's not just plays on the domestic economy, which obviously affected by what happens to GDP and housing markets here like NatWest and Lloyds, but actually you can get great emerging market growth from Standard Chartered, which is the biggest of all my bank's holdings, which is a real play on sort of Asian wealth growth. So that is probably the fastest growing sort of wealth manager, which is about 30% of profits. But wealth managers are generally viewed as sort of high quality businesses, maybe trade on 15 times earnings.
Hughesy's not known for being high quality.
Thanks very much.
Whereas Standard Chartered, trades like a bank on 7 times earnings. So again, it's that sort of where perceptions I think are wrong. Those are the things that really excite me.
Yeah, no. Well,
you would have thought with access to information that stocks would be much better understood today. But do you think investors have become lazy, that they're not looking at stocks properly, or there's not as much sell side because of MiFID?
Yeah, so definitely, if there's a slide in the pack, sort of slide 10, that looks at this. So on average, I would
Mm.
say over time, markets should, certainly on a micro level, become more efficient as there's more competition, more intelligent people looking, information more widely available. And I think that probably has been the case on a global basis. So you think about how many thousands or maybe millions of investors are trying to sort of predict the quarter for Nvidia or Apple or Microsoft. Getting an edge there, incredibly difficult.
Just don't bother.
Whereas if you look at the UK market, back when we started, just around sort of the GFC back in sort of 2007, 2008, there were a lot of big UK desks, so UK only buy side desks, lots of sell side research. It was a very wide number of people looking at UK stocks. And actually, if you look at over time how much money has been invested in this space, it's not just sort of reduced as a percentage, it's reduced in absolute terms. So the slide here sort of shows that there was UK value wise maybe sort of 14 billion invested here back in 2014 when we took on special situations, and it's now about 10 billion. So and of the 8 value funds, I think 5 of the managers have left or changed jobs. So what that means is sort of coverage on the buy side is massively down. MiFID particularly has meant that the sell side coverage has reduced. So actually, particularly as you go down the market cap spectrum, I think the market in the UK is actually less efficient than it was 10 years ago.
It's really interesting.
Which is, from an active manager's point of view, a great place to be, because the ability to get an edge, the ability to spot something that other people haven't seen is actually, I think, higher. And that's one of the very rare places, I think, sort of globally actually in investment where that is the case.
And you talked about sort of Standard Chartered a bit as having, there's a big opportunity there. What other sectors or stocks do you think are particularly interesting at the moment? Are you excited about?
So we've been leaning a little bit more into sort of UK domestics recently, because I think sort of housing obviously had a super strong run through sort of COVID, and we were quite heavily invested there in both house builders and builders merchants, DIY, and obviously as those stocks did well, and then obviously with the big interest rate increase, times became sort of very tough. So actually consumer spend on things like kitchens, bathrooms, sofas are well down, maybe 20% down in volume terms compared to 2019. And so again, we don't try and take a macroeconomic view in terms of what's going to happen in the next 12 months, but actually over sort of a 3 to 5 year view, the chance that volumes increase there is much higher than that they decrease. And then if we can buy players that are sort of taking market share with strong balance sheets, that's something that's interesting. So we already had some exposure. So Norcross would be Triton Showers, but then we bought DFS, the sofa specialist. We bought Howden, the kitchen specialist. Genuit, which used to be called Polypipe, which does a whole host of things for sort of new house build, and RM&I. So that's an area that we've increased across sort of a number of stocks.
Interesting. And what are management teams in those areas saying? Are they pointing to some upward inflection, or are they very much got their
so
battened down?
There's some signs of positive change.
Yeah.
So although it sort of depends on your sort of market positions, I think the market overall is now broadly flat. So it had clearly been falling through the back half of 22 and 23 and 24, whereas year to date the markets are largely stable. You've seen some positive profit warnings. So actually DFS is now growing its top line about 10% per annum. But I think that's particularly because of some of the things that's happened in managerial changes at SCS, which would be their biggest competitor. Similarly, Howden is growing volumes, revenues at about 4%. But again, you've seen sort of Nobia that runs the Magnet brand closing showrooms because they're loss making. So there's market share changes, but the market itself is reasonably flat today.
And we've also, I don't know if it's a position for you, but I think we had good numbers from Currys last week or week before, which is sort of adjacent to all this. But
so again, I don't have a position in Currys, but I definitely have noted they've had some decent results as well. Halfords would have had decent results as well, which is another holding.
Hughes, anything else from you before we wrap? Mr. Wright's a very busy man.
I don't think so. It's just nice to talk UK. not talk about tech stocks. It's lots of opportunities.
I suppose I could ask you whether you're embedding AI into your process and research at Fidelity. How's that sort of looking?
Yeah, definitely. Like, it's early days, but I think like everyone who's probably listening, like it's amazing the power of the apps, and it just makes sort of basic functions much more efficient. So some of the things that I guess we would have had to ask the analyst team, and then maybe they sort of try to find someone on the sell side to get sort of market share data, historic data. That is available much more quickly. So it enables you to sort of sift through things more quickly now, which I think is great. And then when we think about it sort of in the portfolio, it's very much, I sort of think, so where is this going to allow businesses to become more efficient, but where market positions mean that that's not going to be competed away? Because I think the thing is AI is going to be available for all. And therefore, if sort of everyone just gets more efficient, then it's sort of deflationary.
Yeah.
And to be honest, I do worry about actually sort of all the tech companies all competing in this area, because the reason the tech companies are so great is there's just monopolies around lots of different areas, which is not the case in tech.
And buying orders from each other through funding.
Yeah, and obviously that's exactly what you saw sort of Cisco doing back in the dot-com boom. So again, that is a negative sign. So when I think, where could AI be a benefit? It's still an unknown, but I think banks is actually a great one. Like if you think of how many manual processes there are in banks, call centers in banks, sort of IT, coding, those are all areas that can be done much, much more efficiently. And so again, costs can definitely come down because of sort of accelerated tech innovation. Also sort of what are you going to need? Infrastructure is another thing. So again, in the US, you can sort of see that sort of utilities, et cetera, have done really well. Well, that will also be the case in the UK. We own SSE and we own National Grid because there needs to be a big build of grid, not just for AI, but also because of sort of renewables, et cetera. And then also more hidden plays. So Mighty is a big position. Mighty have a division that helps build and fit out data centers. So again, most people think of Mighty as a sort of Serco competitor. And again, they do some big outsourcing contracts for government, but they do far more than that. They do a lot of energy efficiency and small projects that increasingly around sort of fitting energy efficient things for the likes of sort of a big customer like a Diageo or a Lloyds Bank, and increasingly actually building the data centers themselves.
That is interesting.
And that's a company that trades on about 10 times earnings. Because historically, it was seen as a bit of a sort of dirty blue collar outsourcer, low growth, very penetrated market. Took on some risky contracts sort of maybe about 10 years ago now. So again, those areas where the market hasn't really sort of done the work because there's lots of other things going on in a business, and maybe the track record historically hasn't been great. Those are the things that really interest me.
And then just back on that sort of efficiency of the market kind of topic that you sort of touched on, is the sort of rise of passive and increasing share of the market invested in passives. Is that a factor as well? Hence, we've not got so much sell side, not so much buy side coverage at all these stocks.
Yeah, definitely. And that makes the market. So I was at pains to sort of say that sort of the market is probably more micro efficient, but I think it's less macro efficient because that's the increasing amount of sort of dumb money just chasing the biggest stocks. So effectively sort of passive, it just sort of is a free rider on someone else doing the work. But it sort of assumes that someone is doing the work. And so actually it really intensifies sort of trends. And that's why probably the market is more volatile on a day-to-day basis as well, as effectively you sort of see sort of passives having to buy and sell. There's a whole industry of also sort of CTAs and trend following momentum players.
Zero-day options on top of that.
Yeah. So again, we definitely have seen that in stocks that we always buy and sell with limits. And that has been very beneficial in these sort of whipsaw markets because the net of the fund changes very quickly. So again, like when we saw sort of the sort of Liberation Day, we were able to sort of increase the net of the fund by about sort of 200 basis points in a couple of days. And then as the market whipsawed back, that has a clear benefit to to the fund. So that's something that we do both in the investment trust and the open-ended fund, sort of employ that gearing via CFDs. And that is something that's added material value over time, and probably increasing value because of these sort of non-fundamental players, which are sort of trading for non-fundamental reasons. Means that always excites me when the other side of the coin doesn't actually really know what they're doing. That is the best person to be buying off or selling to.
Yeah. And then how long have Special Values been around as an investment trust? I mean, it's nearly 30 years.
Yeah, over 30 years.
Over 30
so
years.
1994 it launched. So we had the 30-year anniversary just under 12 months ago.
And Anthony Bolton was the first manager.
Yes.
So he managed it to 2006?
2007.
Seven, and then Sanjeev took over, and then it's third manager in 30 odd years or so. It's quite impressive.
Yeah. Well, and obviously Special Sit started in 1979,
Yeah.
and Anthony started it then. So it was our first ever fund.
Yeah.
And again, that fund's only ever had 3 managers over 46 years. So that is very unusual in this industry. Yeah.
Well, I'll probably call it to a day there, and let you get back to the day job. Busy day of a few corporate results around the place. I'm sure you've got plenty of things to do. Hughes, anything else from you?
Nothing else from me.
No?
That was superb. Thank you.
No, really interesting,
Brilliant.
Alex. Thank you very much for your time today.
Thanks very
Thank you
much.
everyone for joining us. Any questions, let me know on jonathan.raymond@quiltachieveit.com, and we will see you next time. Thanks very much.
Thanks.